I'm going to spend $50 billion to create 51% of the mining capacity in the world, and I'm going to steal all the Bitcoin in the world and take down the Western financial system. First of all, there's no such thing as cryptocurrency. There are 1,000 cryptocurrencies. In other words, you cannot speak generically about cryptocurrencies. Jim Rickards hates cryptocurrencies. That's not true. I really, really dislike Bitcoin, and I'll tell you why. But there are cryptocurrencies out there that I think are very interesting and worth your consideration. I'm for it. I'm against it. Cryptocurrency means nothing. You have to talk about the specific currency. And I'm showing Bitcoin, Litecoin, Monero, and Ether. By the way, isn't it fascinating how the graphical representation of cryptocurrencies is always a gold or silver coin? Bitcoin's gold and Litecoin's silver, Monero's both, and Ether is gold. I mean, what are they trying to say? I think that psychologically what they're saying is, well, this is nothing, but if we pretend it's a gold coin, then someone will buy it. But I just find this a little bit of an aside. But no, it's the same thing is true with fiat currencies. You can't be like or dislike fiat currencies generically. Some people do because they just hate central banks. I understand that. But it's a big difference between a Venezuelan bolivar and a euro, big difference between a Zimbabwe dollar and a US dollar. So in other words, don't talk to me about cryptocurrencies. Tell me what specific one you want to talk about, and that's a more interesting conversation. I think it's really important because this field is so muddied, the conversation is so muddied, people not distinguishing between blockchain and currency, not distinguishing between different types of currencies, et cetera. I think we need to step back, take a deep breath, and be rigorous in our analysis and think about what we're actually talking about. There's no such thing as a blockchain. There are hundreds of blockchains. In other words, every currency, every token, every so-called smart contract, if you're using Ether, has a different blockchain. So there are at least hundreds, perhaps thousands of blockchains, new ones being created every day. So again, don't talk to me about blockchain. Tell me which specific blockchain you're talking about, because they're not all the same, and this is critical. The main difference, there are many differences in this blockchain technology, but the main difference is validation. Because remember, the whole idea of cryptocurrencies and blockchain and the original Bitcoin and what Satoshi Nakamoto came up with is that we're going to have a trustless system. We're not going to trust banks. We're not going to trust clearinghouses. We're not going to trust exchanges. We're not going to trust central banks. We're not going to trust anybody. We're going to have a decentralized system that a community can validate, and we don't have to rely on anybody in particular. That was the original idea. So the question is, what's your method of validation? And that's what distinguishes one blockchain from the other. So I've listed 4 of them here, but there are others. Proof of work, that's what blockchain uses. And you know what the work is? You gotta factor these, 87-digit prime numbers into prime factors. It's a lot of computer crunching, completely clunky, completely inefficient, non-sustainable. I'll talk about that in a second, but that's Bitcoin. There's something else called proof of stake, meaning you actually, this is what Ether is based on, you demonstrate that you have a certain percentage of the processing power, so you step up based on your stake. There's proof of space. Space is storage space on a hard drive, so I get to vote on the blockchain. I get to vote on validating the blockchain because I've decided to devote a certain amount of my hard drive to that process. There's a new coin called Space Mint. And then there's the Byzantine Agreement, or Byzantine Agreement. There's a version of that called the Federated Byzantine Agreement, which I personally think is the best, much more robust to some of the problems we're talking about, and there are others. But the point is, don't talk about blockchain. Say, okay, what's your governance model? What's your validation model, et cetera? And then ask yourself, is that sustainable? Is that robust? Will that resist an attack? Are your cryptocurrencies going to be stolen? These are the questions you have to ask yourself, and there are no generic answers. So I cannot emphasize enough. Coin by coin. I hate to use the word coin, whatever, token by token, blockchain by blockchain. Be rigorous and ask yourself what's sustainable. Now, Bitcoin, Ripple, and Ether, and some of these other cryptocurrencies, not all of them, but the best known are going to fail. When I say fail, they're going to, Bitcoin might have a $200 value as a token for criminals. I think criminals and terrorists might find a a use case at about $200 per Bitcoin, but they're basically not going to be anywhere near where they are today. Why do I say that? I don't want to make a claim without backing it up. The first point is they're non-scalable. Transaction times are slow, and then when you say that to Bitcoin people, they go, aha, the Lightning Network is right around the corner. You know, Lightning's going to, we'll see. You know, they said that about segregated witness. They said that about some of these other solutions. They don't seem to get community support. They keep forking the Bitcoin, meaning one day you wake up and there's 2 blockchains instead of 1, or whatever happened to that whole idea that we weren't going to have inflation and we weren't going to pull new cryptos out of thin air. But these solutions, you have to understand what the solution is. So what they're saying is nobody has a solution for the inherent slowness, clunkiness, non-scalability of the original Bitcoin blockchain. There's no solution for that. So when you hear about solutions, what are they? Well, what they're saying is take a bunch of transactions offline. So everybody in the room could form a group, or let's say every coffee shop in Brooklyn, New York, every coffee shop in Vancouver could form a group. And all the people who want to buy coffee would join that group. And we would agree, so we're in our own little bubble over here, and we would agree that all of our Bitcoin transactions among each other don't go on the blockchain. They just get settled in this sort of separate cloud over here. And then we net them out. So, you know, I pay you 5 Bitcoin, and you pay the person next to you 4, and he pays the lady in the back of the room 10, and she pays me 7. And we net it out, and then periodically, and it could be daily, weekly, monthly, or whatever, we net all this stuff out, and then we take that net and we put that on the blockchain so that the amount of transactions that have to go on the blockchain is greatly reduced. That's true. But what are we doing? We've created our own network. I got to trust the coffee shops. How do I know they're not going to steal my money? In other words, it's only a solution because you're completely negating the original idea. Well, sure, if you want to tear up the original idea and start over, that's fine, but don't tell me you're adhering to the idea of a decentralized trustless network, because you're not. All you've done is create another network. Somebody, I get trolled on Twitter all the time. People tell me I'm an idiot and I don't know technology and all that stuff. And then my more sour moods, I tell them I was coding before they were born. But as far as some of these things are concerned, somebody said, well, you don't understand payment channels, and I actually do. And I said, yeah, I understand payment channels. We had those in the 50s. They were called party lines, which is, you pick up the phone and someone's talking, you got to ask them to get off the phone so you could go. In other words, there was an AT&T network, at least in the United States, but other people could jump in on this little side thing. That's all it is. These are party lines. So that doesn't work. Non-sustainable. The energy usage to solve the problem and make the proof of work in Bitcoin is now greater than the annual energy output of Ireland. Imagine taking all the electricity used in Ireland in a year, and that's how much we have to use to crunch numbers. By the way, every applied mathematician will tell you that prime factoring is a trivial problem. It's like an uninteresting problem. But it takes a lot of computing power to do it because the numbers are so big and the possibilities are so great. So we're just wasting the entire electrical usage of Ireland. In a few years, it's going to be the entire electrical usage of Japan. Who in this room thinks that governments are going to allow Bitcoin miners to use as much electricity in a year as the entire country of Japan, the 3rd largest economy in the world? That's not going to happen. It's not going to happen. It's not very green. It's completely wasteful. In other words, it can't happen. So that's why I say it's non-sustainable. It's going to hit a wall. Non-regulated, I don't have to remind you of all the frauds, new ones popping up every day. It's not just exchanges. Exchanges are, how do exchanges work? I want to go to a Bitcoin exchange. Well, you got to go in, you got to open an account, just like Merrill Lynch or Charles Schwab, right? So, or Toronto Dominion. So you go, you give me your name, your address, your social security number, your bank wire information, give them all that information, and then send them dollars. And they say, okay, you got some Bitcoin, here's your confirmation. Really? How do I know you didn't just take my dollars and send me a phony baloney confirmation? How do I know you're not, a Ponzi? You're using new money to pay off the old money. How do I know you're not Bernie Madoff with a computer engineering degree? How do I know you're not a bucket shop? How do I know any of those things? The answer is you don't. So good luck with that. Not to mention Bitcoin whales. They estimate there are 1,000 people who control 40% of the Bitcoin. Now you got millennials buying, 1/100th of a Bitcoin for, $10 or whatever the math is. $100. But you got these, I call them the whales, these 1,000 people who have 40% of all the Bitcoin. You don't think they have a big vested interest in keeping the price up? And you don't think they wash trade, do wash sales? So A sells to B for 10,000, B sells back for 11,000, A sells back for 12,000, B sells back for 13,000. This is called painting the tape. It's the oldest trick in the book. And there's no profit and loss because we're selling the same Bitcoin back and forth. But what we are doing is creating a ticker that gets the millennials, I shouldn't pick up millennials, 3 millennial children, but gets people all over the world, maybe a garage mechanic in South Korea took out a home equity loan or hocked his inventory, put his entire life savings into Bitcoin and has now been wiped out and is desperate and suicidal. That's what's going on. It's basically rich people stealing from the poor. Not a good business model in my view. And then finally, there's no use case other than criminals, terrorists, or tax evaders. Why is Bitcoin better than Visa unless you're a criminal? Now, if you're a criminal, I get it. If you're buying child pornography, you want to use the dark web and use some cryptos and all that. And if you try doing that with Visa, you'll probably get a call from the FBI. So I understand why it's good for criminals. But if you're not a criminal, if you're not a tax evader, if you're not buying child pornography, if you're not an arms dealer, if you're not a terrorist, then why is Bitcoin better than Visa? There's really no use case for it other than crime. And then it's not elastic. And this is important because there's a finite number of Bitcoins, 21 million Bitcoin. They're getting closer to that level every day. And everyone's like, this is a good thing because, the problem with central banks is they print all this money and we're going to have inflation. By the way, we haven't had any inflation for the last 8 years. Separate issue. I'll come to that if we don't run out of time. But, we hate central banks. They print too much money, blah, blah, blah. So we're going to cap the number of Bitcoin. But money supply has to be elastic. It can't be too elastic. The problem with central bank money is that it's too elastic. The reason, by the way, gold is such a good form of money is that it grows slowly. It grows at about the tempo of world growth. It grows at about the tempo of population growth. Not exactly, but close enough that it's the best form of money anyone's ever discovered. But the problem with Bitcoin, when you hit a hard stop, which they will, and the economy keeps growing, but you want to back it with Bitcoin, so here's your money supply and here's your economy, that's inherently deflationary, right? Because each Bitcoin's got to support more and more growth, meaning your Bitcoin is worth more in theory, but the problem is you never get there. Why? Because if you have a deflationary currency, there's no bond market. The money supply grows based on credit, based on loans, based on various forms of borrowing. The money supply is just a foundation, and the economy grows with credit. Nobody wants to borrow in a form of money that's going to be more expensive when you pay it back. I'm not talking about interest. That's always part of the equation. But I'm saying the money itself is worth more when you have to pay back the loan. No one's going to borrow on that loan, therefore no bond market, therefore no viable form of money. So these are all the reasons why this is going to hit the wall. What's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain's broken down, the shelves are bare. So all true, that was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, or tripled the orders. They said, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness. The Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve, and they're focused on the unemployment rate, which is not a good measure of what's going on in the labor force. So we're flying into a really bad recession. But you've got this pivot narrative. You can't quite get rid of that. Some of the buy the dips people are still around, so count on them to buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the Nasdaq dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. There are two huge fallacies in that narrative. The first one is, who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling you what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. But the second fallacy is even bigger. Is tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets, where you ended up losing everything, but for a couple of days or weeks even, it's the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment, and we're going to wake up with a severe recession, high unemployment, and a much lower stock market. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, we may have a very bad recession, possibly worse than 2008. But 2008 is a model, and that may be what we're heading for, bearing in mind that these are two separate vectors. I would say that the Fed may actually cut rates sooner than Michael Wilson expects, and maybe sooner than a lot of Wall Street expects. And you say, well, Jim, isn't that good for stocks? And the answer is no, because the reason they're going to cut rates is because things are going to be much worse than even Wilson and others expect, which is going to cause the economy to crash. And then you will pivot, not because you want to, but because inflation might be zero, could be negative. We could actually be into deflation. We're already in disinflation. Disinflation is when you still have inflation that's coming down. That's disinflation. It's still coming. You still have inflation, but it's coming down. Deflation is when prices actually go down. Inflation is negative. It's not a question of going up at a slower rate. It's a question of actually going down. And then that feeds on itself. That's a central banker's worst nightmare, because people say, why should I buy anything? I'll just sit in my money and wait for the price to come down, maybe buy 6 months from now, or maybe wait a year. And then that feeds on itself. And then unemployment goes up, businesses shut down, stock markets crash, et cetera. And the Fed pretty quickly turns around and cuts rates. Now, we've actually seen this movie, and it wasn't that long ago. Go back to 2015, December 2015. That was the famous liftoff. Remember, interest rates had been at zero, I believe, for six and a half years at that point, the zero interest rate policy. And then Janet Yellen raises interest rates 25 basis points. Okay, it was a baby step, but at least they went up for the first time in 6 or 7 years. And actually, it was longer than that, because they were at zero for 6 years, but there was a series of cuts to get to zero. So the last time they had raised rates was even further back. That was like 2006. So that was more like 9 years. So she raises interest rates 25 basis points, and then waits a year. The next rate hike was December 2016. They waited a whole year just to go 25 basis points more, almost as if they would have been embarrassed if they had done nothing in all of 2016. I think it was the only reason they did it. But then when Powell came in 2017, that tempo picked up. It was like kind of nothing burger for a year and a half. But then Powell's like boom, 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 25 basis point hikes, and got the rate all the way up to 2.5, which doesn't sound like a lot, but considering that they had been at zero for 6 years, that was pretty steep. But what happened between October 1st and December 24th, 2018? The stock market collapsed. I mean, the Dow Jones, the S&P, and the NASDAQ all fell about 20%, just short of a bear market. It was like 19.8%, 20% to all intents and purposes. But that was in less than 3 months. And the Fed kept raising rates in the middle of the stock market crash. This shows you how out of touch they are and how behind the curve they are. So the last rate hike was December 14th or 15th. They got to look at the calendar. It was right around the middle of December, 14th or 15th. Even after 2 months
of crashing stock prices, they raised rates one last time. They just kept going, and kind of what we were talking about earlier. And then finally on December 24th, what I call the Christmas Eve massacre, the NASDAQ fell 3% in one day. The Dow was like about 1.8%, S&P was over 2%, and the NASDAQ was 3%. And then the Fed got religion, like, oh, we went too far. We're the last to know, as always. So early January 2019, Powell said, use the word patient. It's one of those code words. It means, patient means we're not going to raise rates unless we tell you. So they were on pause. And then by late 2019, they cut rates. And then along came COVID. And by March 2020, they were back to zero. You had this huge round trip from zero in November 2015 to about 2.25, 2.5 in Dec 2018, back down to zero by March 2020. And what was that all about? Well, the Fed went too far, didn't know what they were doing. The economy was weaker than they expected, and they raised rates. So bring that scenario forward to today. I feel like I'm watching the same movie, which is, okay, the Feds, they got the gumption, they raise rates. Now they're much higher than they were in 2018, but they're flying into a hurricane. They're flying into a very weak economy, seen by a lot of metrics: housing starts, global trade, ISM surveys, industrial output, inventories. There's tons of negative data. It's not the kind of thing that doesn't make the headlines the way CPI does, but it's all there. It's hard data. So it looks like a bigger, better version of what happened in 2018, and I would expect a worse outcome. So my point is, the Fed may in fact cut rates sooner than Wall Street expects, sooner than Michael Wilson expects, but not for good reasons, but for very bad reasons, because we're in a severe recession. So the bottom line is, we've had the supply side inflation. Now, we have not seen it come from the demand side, but let's say you're the Fed, okay? All you want to do is get inflation under control. You kind of don't care where it's coming from. You just want to get it down to 2%. So then the question is, okay, how is the Fed doing at getting inflation to the target? The 2% we talked about, and explain why that's their number. The answer is they're making progress, but they're not there yet. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know we'll probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so, in other words, too bad, Well, the Fed has no tools to affect the supply side. The Fed doesn't drive trucks. They don't drill for oil. They don't plant crops. They don't run tractors. They don't do anything that could alleviate the supply side problems. All the Fed can do is destroy demand, and that they can do. When you raise interest rates enough, mortgage rates go up, credit card rates go up, costs of working capital go up. All that tends to slow the economy, and it causes people to tighten their belts. But just think of the conundrum. The inflation is coming from the supply side. The Fed can't do anything about the supply side, but they can crush demand, which should reduce inflation. But how much do you have to crush demand when that's not the problem? It's coming from the supply side. How much demand do you have to destroy to actually affect the supply side? The answer is a lot. And this is what Jay Powell has been saying. Unemployment has to go up. We're going to be in a recession. We got to crush this thing before it gets out of control. And you got to crush it even more, because that's not even where the inflation is coming from. It's coming from the supply side. Supply chain bottlenecks have been alleviated to some extent, not completely by any means. And it was always a case of popping up here and there. It's not like you went into a supermarket and all the shelves were bare. It wasn't East Germany in the 1950s. But something would be missing. It could be the peanut butter one day, or the canned goods the next, or spaghetti the week after that. That has alleviated to some extent, not completely. But again, the reason it has been alleviated is a very bad one, which is that demand is down. In other words, the Fed is destroying demand, so people are buying less. So, grocers and retailers and boutiques and suppliers are able to keep more things on the shelf, not because all the logistics problems have been solved, but because the demand is down, because that's what the Fed's doing. So Supply chain better, yes, but for good reasons or bad reasons? Well, it's for bad reasons because demand is down. And that's another thing leading us into a recession. So a couple of things. We should probably, without taking too much for granted, we should probably just define BRICS. It's an acronym: Brazil, Russia, India, China, South Africa. So those are the BRICS. And started in 2002 as a Goldman Sachs marketing gimmick. Jim O'Neill and some partners came up with it. And all they did, I'm not diminishing what they did, but they kind of took the leading economies, took out the G7 and Switzerland and a couple of obvious leaders, and said, well, who's left? That will be the up-and-comers, the fastest-growing developing economies. And they got Brazil, Russia, India, and China. That was kind of easy. And then a few years later, they added South Africa, which was a little bit of a favor to South Africa. South Africa is not anywhere near as large as those other economies or as important. However, it is one of the biggest economies in Africa. And if you're going to be the BRICS, you probably can't just be South America and Asia. You probably need to include an African country. So they picked South Africa. So for a couple of years, it was a Goldman marketing brochure. But then in 2006, at the United Nations General Assembly in New York, annual meeting, heads of state and foreign ministers show up from all over the world, but they have what they call these bilateral meetings on the sidelines. And sometimes there are 3 or 4, say, hey, we're all here, let's just grab a conference room and sit down and talk. Well, Brazil, Russia, India, and China, they sat down and they said, yeah, we actually have a lot in common, a lot to talk about, and we added up, we're a pretty powerful group. So they formalized it. And then in 2009, they had a summit conference, a formal summit conference with an agenda and all that in Yekaterinburg in Russia, in the Russian Federation. And they solidified, okay, we're a group, we're going to work together. And they did. And over the coming years, they multiplied numerous. People say it's the BRICS meeting. They have about 190 meetings a year. They have working groups on women's rights, sports, the environment, climate change. It could go on and on. It's a very active, what they call secretariat, which is central organization. A few years later, in 2014, they formed what they call the New Development Bank, NDB. Well, what's the New Development Bank? First of all, it's got 100 billion of capital, part paid in, part callable, but it also has borrowing power with that kind of ownership and that kind of capital on the balance sheet. They've got hundreds of billions of dollars of borrowing power. They could easily get a pretty good credit rating. And the purpose is to make loans for development projects to the member countries. And by the way, there are stockholders of the New Development Bank who are not BRICS, but they're kind of in the club. Well, what does that sound like? The World Bank on their own terms with their own governance. Okay, the following year, they created something called the Contingent Reserve Arrangement. Well, what's that? Again, they threw in a couple $100 billion from the members. China was the biggest contributor. Again, with borrowing power, so take a couple $100 billion times 5 or 10, that's your power. And this institution was designed to be a swing lender to members who were running trade deficits or facing a run on their currency or facing the prospect of having to close the capital account. Exactly what we saw in 1997, 98, by the way. I was there for that one. We ended up with long-term capital. Well, a pool that is a swing lender to countries with balance of payments deficit, what does that sound like? That's the IMF. So basically, they copied the World Bank, they copied the IMF. And I want to make 2 points. Number one, it's not like the BRICS popped up 6 months ago and said, hey, we're going to have a new currency. It's like Mickey Rooney and Judy Garland putting on a play. This has been in the works for 17 years. And it's typical Russian, Chinese. They're very methodical. So they've duplicated the World Bank. They've duplicated the IMF. Now they have applicants for membership. And there are, I think, 21 or more countries who have applied, well, 7 have formally applied for membership. They filled out their college essay and they want to be members. And then another 13 or 14 on the waiting list, so to speak, and will perhaps eventually become members. But when you add those in, some of these will be admitted, starting with Saudi Arabia. Okay, so what happens when you let Saudi Arabia into the BRICS, given the other members? You have 2 of the 3 largest oil producers in the world, Russia and Saudi Arabia. You have 2 of the 3 largest nuclear arsenals in the world, Russia and China. You have, throwing India in and some others, you have about 50% of global population, 54% of global GDP using purchasing power parity. You can debate the method, but just if you do purchasing power parity, you get over half of GDP, 30% of the global landmass. I could go on and on. My point is, I did I learned development economics in the 1970s. We had something called the third world. It was Russia, or Soviet Union, and the U.S. And then there was the third world, and all you knew about them was they were poor, and you had to get them off the runway. We actually had the runway theory of how you grow. Turned out to be wrong, but that's what we learned. Well, this is not the old third world. These are not basket cases. These are many of the biggest economies in the world that collectively have enormous power, natural resources, gold reserves, landmass, population, military, and again, I could go down the list, but this is a bloc that is as powerful in its own way by a lot of these metrics as the collective West, which I would call, US, Canada, Western Europe, Japan, Australia, New Zealand, and a few others. So that's who this group is. Now, there are a couple other groups that may join forces with the BRICS. There's something called the Eurasian Economic Union. Everyone's like, what the heck is that? Well, this goes back to the early 2000s. This was Putin's answer to the EU. He said, well, you got the EU, we got the EEU. Now it's Russia and some Central Asian republics, some, Belarus and Tajikistan. I'm not saying this is France, Germany, and Italy, but it is a group that have reduced tariffs and improved trade between themselves. And there's another powerful group called the Shanghai Cooperation Organization, led by China. And these are mostly Central Asian republics, including Kazakhstan and some others. But they're all talking to each other. Now, what's the common denominator? Well, it's basically Russia and China. China's a member of two. Russia's the only country in the world that's a member of all three. So through pretty simple inference, you could say, hey, Russia and China are running the show. And it's very likely that when this thing plays out, and I'll talk about the thing, I realize we're glossing over that, but when this new currency plays out, that those other countries will join in. When you do that, and I found a really cool widget. It's a map of the world that's blank, and you can go country by country and fill in by color. Just click on it and give it a color. And I did that. And I was like, okay, here's the BRICS, it's 5 countries or whatever. Well, here are the applicants, it has another 20. And here's the SCO, a few more. Some of them are members of both. Here's the EEU, has a few more. Again, many are members of both. And you keep going, and all of a sudden, like a light bulb goes on. I said, that is Halford Mackinder's global island, what he called the world island. And this goes back early 20th century, first, probably greatest geopolitical theorist in history. Got to read his book if you haven't read it. It's pretty short. But he had this idea of the world island. That is exactly what they're building. Now, why is that important other than the obvious, which is more collective economic and population power? By the way, output of wheat, pick your metric. This dominates the world. Well, for one thing, if you're going to have a currency union, the more countries you have, the more likely you are to be successful. Let's just kind of digress for a second. And what are the headlines saying? China and Saudi Arabia are talking about selling oil for yuan. Brazil and China do large multi-currency deal where they accept each other's currency. UAE, China, same thing, selling oil for yuan. Russia, China, using yuan and rubles as payment methods for whatever they sell to each other. Russia sells natural resources, China sells semiconductors, manufactured goods, and so forth. And there are a number of those. I don't have to list them all, but there are 10 or 15 of these. The reason they've all fallen short, and very few of them have actually come to fruition despite the headlines, is when you have two countries and they're going to trade with each other and accept each other's currency, and you can do that, you're limited to what you can do with that currency. This is why the Russia-India thing is starting to break down. Russia's been pumping oil to India. India's been paying in rupees, but how much curry do you need? And Russia's starting to balk. They're like, hey, we're up to our eyeballs in rupees. We need a better system. Well, when you have a multilateral, multi-country currency union, that problem goes away. Now, Russia sells oil to China. China pays in BRICS, the BRIC currency, pays you in BRIC. But Russia can take the BRIC and turn around to Argentina and say, we'd like to buy, or Brazil maybe, and we'd like to buy some Embraer aircraft. And Brazil gets the BRIC currency, and they can turn around to China and say, we'd like to buy some rice. And then China takes, et cetera. And so you've solved the quasi-barter problem.